How's everybody doing? Welcome back to another episode of The Banker Next Door. I'm your host, Dr. Joe Berquist. So today I have a very interesting episode to everyone. KPMG, one of the big four accounting firms, basically got in some hot water here over the last couple of weeks as a scathing Democratic Senate report came out, basically accusing the accounting firm of basically really dropping the ball during the 2023 banking crisis that was involved with Silicon Valley Bank, Signature Bank, First Republic Bank. So I'm going to share with everybody today a couple of articles here, one from Banking Dive, another one from the Wall Street Journal, and then I'm going to actually show you the actual report itself. Now, in the links down below, if you want to go look at this, is a link to the Banking Dive article. The Wall Street Journal is subscription only, so you need a subscription to go look at that. But also, I put a link to the actual report itself in the description down below if you want to go take a look at those. But let's get into this Banking Dive article here. So, Senate report on Silicon Valley Bank rips KPMG, reveals CFO role. So the Senate Subcommittee's report stems from a 28-month investigation that reviewed nearly 100 hours of briefings and interviews with auditors and regulators. So a 292-page report from the Senate's Permanent Subcommittee on Investigations minority staff released this week criticizes Big Four firm KPMG for the clean, unqualified audit opinions it issued to Silicon Valley Bank, Signature Bank, and First Republic Bank prior to their collapse in 2023. Now, it's rather astounding that KPMG was the accounting firm for all three of those banks that failed there in that mini crisis at the beginning of 2023. It's pretty wild. But anyway, the report also reveals details about behind-the-scenes discussions between the auditor and SVB's CEO and another bank executive in the fraught days leading up to the March 2023 bank run, shedding light on the close ties between the auditor and the bank. The findings are the culmination of a 28-month investigation that reviewed more than 400,000 pages of documents and nearly 100 hours of briefings and interviews with auditors and regulators, according to a press release from Senator Richard Blumenthal, a Democrat from Connecticut, highly critical of the auditing industry. The PSI minority staff report's title page is emblazoned with, quote, "This industry is a joke." So KPMG had years-long awareness of the problems at the banks that precipitated each bank's eventual failure, but either ignored or justified these concerns, leaving the depositors and investors unaware of the bank's deficient record-keeping, troubled risk management, and other concerning practices, the report stated. I would also remind people the regulators were well aware of the problems with these banks for years ahead of time. It wasn't just the accounting firm. The regulators knew this too. KPMG slapped back at the report in an email statement to CFO Dive from a company spokesperson. The minority staff report is a misguided and erroneous opinion that stands as an outlier from the multiple investigations that have been conducted on these banks, none of which point to an auditor role in the failures, KPMG asserted. The minority staff report also contains errors and draws wrong conclusions, often by omitting critical context. In addition, KPMG said the report calls for auditors to go beyond current PCAOB standards. We audit to the standards because that's our role in the financial system, and it's the role we are trained and resourced to do effectively. Going beyond the auditing standards and our expertise undermines the role of regulators, management, and boards in mitigating enterprise risk, the statement said. Yeah, can't argue with that. The report itself states that no regulatory assessment suggested that KPMG played a role in the failures of the banks, and notes the subcommittee does not take a position regarding whether KPMG's audits of the three banks violate any auditing standards. But it does assert that KPMG ignored known dangers for all three banks. The report states KPMG did not acknowledge at least 6 serious risk factors that could threaten SVB's survival as it finalized the audit 14 days before the bank's failure. Although KPMG disputed the subcommittee's assessment for 5 of the conditions while acknowledging a documentation error related to the 6th. With regard to the other 2 banks, the report said KPMG dismissed allegations of fraud and overlooked record-keeping deficiencies at Signature and failed to warn First Republic Bank of going concern, risks it faced, or to challenge an earnings release that didn't disclose risk. The report comes in the wake of a recent failed attempt by Republican lawmakers to eliminate the Public Company Accounting Oversight Board, the auditor watchdog created following the Enron and WorldCom accounting scandals in 2001. In contrast, the report asserts the auditing industry is under-regulated, in need of reform, and that the PCAOB has been undermined by the deeply entrenched auditing industry from its creation. The report also examines the close relationship between KPMG and the banks, noting that KPMG audited Silicon Valley Bank for 28 years, Signature for 21, and First Republic for 31 out of 34 years. There are currently no regulations in the U.S. that limit the number of years that auditors can provide their services to clients, but there has been a long simmering debate over whether there should be limits on how long an auditor can serve a client without a too cozy relationship jeopardizing an audit's rigor. While the subcommittee's review did not find a direct causal link between the lucrative, long-standing relationships KPMG enjoyed with Silicon Valley Bank, Signature Bank, and First Republic Bank, and the outcome of their respective audits, the apparent familiarity raises concerns relevant to the entire auditing industry, the report states. The longstanding relationship between KPMG and SVB showed signs of strain in January of 2023 after the bank's audit committee chair emailed the SVB CFO, Daniel Beck, and KPMG's lead partner for Silicon Valley Bank to let them know of the board's decision to seek bids for a new auditor for the first time since 1994, when KPMG began auditing the bank. The partner then emailed another top Silicon Valley executive who assured them that he personally didn't have any issue with KPMG as an auditor, but that the board felt the proper governance, this is the right thing to do. In the same email thread, the bank executive subsequently suggested KPMG sponsor a women's cycling team he was affiliated with, for which promotional materials suggested the price would be between $3 million to $4 million. The report said the bank collapsed before the sponsorship conversation concluded. Separately, on January 25th, 2023, the KPMG partner said in another email that he had been having some positive interactions through text messages with Mr. Beck, and he and I are going to meet for a drink. The partner told a colleague that Beck wanted to either delay the FRP or eliminate the FRP proposal. The report states that the partner and Beck ultimately met on January 27th, 2023 at the Blackhawk Country Club in Danville, California. When asked what was discussed at the meeting, the partner told the subcommittee that they talked about high quality audits that we have performed for SVB, according to the report. Attorneys for Beck did not respond to a request for comment. So very interesting stuff here. And then let's go to this report from the Wall Street Journal. So KPMG ignored flaws in regional banks before the 2023 crisis. Senate report finds auditing industry reform is needed, Senator Richard Blumenthal says. So KPMG ignored several flaws at Silicon Valley Bank and two other banks before their collapse in 2023, signs of shortcomings in their auditing oversight, according to a report from Senate Democrats. Now, we're not going to go, hash through this whole thing again here. So let's go through. At Signature Bank, KPMG dismissed credible allegations of widespread fraud and justified shortcomings in the bank's record keeping, the report said. The subcommittee also said KPMG didn't alert First Republic Bank's board of directors to concerns the auditor had about its ability to survive just before its failure. Silicon Valley Bank, Signature Bank, and First Republic each had been between roughly $100 billion and $200 billion in assets. Some bankers have called for the expansion of deposit insurance, particularly in the wake of the bank failures. Meanwhile, the Trump administration has been fast-tracking broader deregulatory efforts in the banking industry and elsewhere. And so that is the Wall Street Journal article. Now I just want to show you guys the report itself. We're not going to go through this whole thing, but this is the actual report, the Permanent Subcommittee on Investigations. It says right here, this industry is a joke, how KPMG's unqualified audits of Silicon Valley Bank, Signature Bank, and First Republic Bank allowed troubled banks to hide their failures in plain sight. All right. So there are a couple things on this. Number one, I will say that I think this report is somewhat political, because at the end of the day, it doesn't come out and say, oh, well, this is KPMG's fault or KPMG is guilty of X, Y, and Z. It doesn't do that. It's really this report is really more a critique of the auditing industry itself, and basically saying like, hey, should we have the limits on how long people can audit things? They also want to protect this. What's it called? The PA. Where is this thing? I'm looking at what is this thing called? What is it? How am I missing this? The PCAOB, this thing that's established. Obviously, Republicans have basically said, yeah, this thing is hasn't really done what it was supposed to do. Is kind of a waste of time. So we want to get rid of this thing. So I think that's partially, this report is to try to kind of cover that organization to basically say, hey, look, these guys are doing what they're supposed to do. They are doing a great job. And we not only do they need to stay, but we need more. We need more oversight and more, this and that. Which, okay, fine, we'll take that on its face value. But I want to point out a couple of things because I have just studied this whole situation a lot. So number one is that First Republic Bank, in a lot of ways, was like collateral damage. It wasn't necessarily tied in to Signature Bank and Silicon Valley Bank. So you have to take a step back here, and you have to recognize that Silicon Valley Bank and Signature Bank were heavily involved in the crypto space. They had a bunch of deposits from the crypto space. Now, some people will argue that point. Some people will say, "Oh, well, no, they didn't have precise, crypto deposits or whatever." Yeah, okay, they didn't have direct crypto deposits, but what they had was they had a lot of deposits from hedge funds and private equity funds and high frequency trading firms that had made a lot of bets on the crypto space. And as FTX and the crypto industry blew up in 2022, you heard this giant sucking sound of all that money going back out to basically cover all those crypto bets, basically like a margin call that went bust. And all of this ran through a bank that is missing from this report, which is Silvergate Bank. And Silvergate Bank operated what's known as the SEN network, the Silvergate Exchange Network. That was the main rail system between the crypto world and the banking world. And the main three crypto banks were Silvergate Bank, which was a $10 billion bank out there in California. And then you had Silicon Valley Bank, and then also in California, and then Signature Bank in New York. Those were basically like the two backup crypto banks because they were obviously much, much larger than Silvergate Bank. Now, all of these organizations failed like a domino. March 3rd of 2023, Silvergate Bank shuts down the SEN network. 5 days later, Silvergate Bank fails. Then 2 days later, Signature Bank fails, or Silicon Valley Bank fails. 2 days after that, Signature Bank fails. A month after that, First Republic Bank goes down. And like I said, First Republic Bank was kind of collateral damage. Now, do I acknowledge that these banks had the underlying issues that were there? Like, in other words, they had these unrealized losses in their bond portfolio, which were created by what? The Federal Reserve and their massive interest rate hiking campaign. Now so the interest rate hike, obviously caused rates to go way up. And then they bet stupidly in their bond portfolio. They went very long in their bond portfolio. So their bond portfolios got crushed, which caused a liquidity problem. Now, before this issue, nobody talked about uninsured deposits. Nobody talked about that. That was not like a thing before this happened. And now, obviously, I do think they do need to change deposits, especially for businesses. They need to cover the deposit insurance fund does need to cover more business deposits. What amounts, what levels, I'm not sure, but I think that's being worked on right now. So, but the other thing that came of this is that this is basically like your classic bank runs at the end of the day. And now what we're learning, because of the internet age that we live in with social media and everything, that these bank runs can happen not in days, but in hours. So that was a game changer here. And I don't think you can necessarily put that on KPMG. Now, the other thing to understand here is that I believe, this is my assessment of what happened, is that I believe that these banks had these underlying issues. They had, the high amount of uninsured deposits. They had the unrealized losses in their bank bond portfolios. And I believe that their exposure to crypto, now I believe, so think of it like those issues as being the gasoline, right, on the wood. But the implosion of the crypto market and the sucking out of the deposits from the crypto market, I believe that was the match that lit the fire, and it basically set all this ablaze. And and again, can you blame KPMG for a lot of this stuff? No. And the other thing is that Silicon Valley Bank was a very, very unusual bank in the banking industry. They had they had a very unique business model. They, again, were the Silicon Valley Bank. They dealt with a lot of startups. They dealt with a lot of venture capital. They dealt with a lot of unicorns. They dealt with a lot of customers that most normal banks would not touch in 100 years. But they became very successful in that niche business that they had. Signature Bank is very different in New York, because Signature Bank really was a commercial real estate lender, and they were one of my favorite banks for a long time. They did a great job, and unfortunately, they just, like you said, they decided to kind of get out into the crypto space big time, started to get into other things, and they kind of got away from, I think, what made them a really, really great bank in New York. And it's kind of unfortunate what happened there, but at the same time, in other words, you look at things like, you look at Arthur Andersen with Enron, you look at EY with like the whole Wirecard thing, and if you don't know about Wirecard, that was a crazy thing. Wirecard was basically like the PayPal of Germany. And they blew up, massive fraud. There's a whole. I did an episode covering a documentary that they did on it on Netflix. So if you want to go check that out, you can go check that out. But so again, it's not unusual for a lot of these big accounting firms to get caught up in these big failures, because after the dust settles, everyone, particularly politicians, are pointing the finger, looking for people to blame. And, there's the accounting firm. Now, do they bear maybe some of the blame here? Yeah, I don't think it's completely unreasonable to say that, maybe they should have been more on top of some of the things that were going on. But can you point the finger solely at them and say it's their fault that these banks failed? No, absolutely not. That's a bridge too far. At the end of the day, it has to fall to the bank boards and the bank management and the regulators. Now, and don't forget, this was also a highly political thing. Barney Frank, that Frank, the guy who wrote Dodd-Frank, he sat on the board of Signature Bank. Silicon Valley Bank was filled with a bunch of Obama appointees. It was a highly political board with a whole bunch of Democrats on it. The CEO of Silicon Valley Bank also sat on the board of the Federal Reserve Bank of San Francisco, which was responsible for regulating Silicon Valley Bank. So how could you have that CEO sit on the board of the Federal Reserve Bank that was overseeing the regulation of his own bank like that? So there were a lot of issues and big things that happened here with this whole thing. And again, Janet Yellen rushing in to bail these banks out, and then in congressional testimony, when she was pressed and basically said, well, hey, you bailed these guys out, so when my bank over here in Oklahoma needs a bailout, you're going to bail us out, right? And she flat out was like, no, we're not going to do that. These were wealthy, highfalutin people, so we had to bail them out, and they were politically connected, and we had all of our buddies, sitting on their boards. So of course, we had to bail them out, but anybody else, hey, tough cookies. So, so again, there are a lot of issues with this whole thing, but I thought this was a very interesting story here. I wanted to bring it to everybody, kind of, again, more updates on the whole crisis of 2023. And, I'll keep an eye on this, and if anything more of it comes, I will certainly let everybody know. But with that being said, if you like this episode, please make sure to like, share, and subscribe. That always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below. I'd be really curious to see what people think about this one. And as always, make sure to check out some of the other content on the channel. I hope everyone has a wonderful day out there. I thank you all for listening. Oh, and one last thing, don't forget to check out the BND Strategy Room, the main show of the channel, live every Saturday night here on YouTube at 8 p.m. Please make sure to check that out if you've never checked it out. And with that being said, I hope everyone has a great day, and I will see you again real soon. Thanks a lot.